The fire hose of news from America can feel like a lot these days.
If you're trying to figure out what to make of it all, we got you.
I'm Katie Simpson.
And I'm Paul Hunter. We're correspondents here in Washington,
working just around the corner from where much of the action is taking place.
2 blocks from the White House.
And that's the name of our new podcast.
For top-notch analysis of U.S. politics from a Canadian perspective, find 2 blocks from the White House every Wednesday wherever you get your podcasts,
including YouTube.
Frequency Podcast Network. Stories that matter, podcasts that resonate.
Got some numbers from Stats Canada recently about the state of the economy at the end of 2025. The fourth quarter was tracking toward an overall negative performance. The November GDP output was flat, but manufacturing was down distinctly on a year-over-year comparable. The labor market, it's been showing signs of strength, we'll say, in the later stages of 2025, although that was kind of suspect because a lot of the jobs created were part-time. Retail spending has been kind of all over the map, and we're coming into 2026 with, of course, the overhang of everything that was the same as 2025, i.e. Trump, trade, and tariffs. And the Bank of Canada, in its first policy announcement of the year, Governor Tiff Macklem sounded very uncertain about which way things would go in 2026, citing the lack of certainty about the upcoming trade talks, the renegotiation of the North American Free Trade Deal with the U.S. and Mexico. So there's some big questions about where the economy is. So there's some big question marks about the current state of the economy to start the new year. It's sputtering along. There's question marks whether or not the Bank of Canada does anything with policy. Some have talked about raising interest rates. Well, my guest today thinks that the economy might actually be in a recession, even though the numbers don't bear that out. He thinks the Canadian dollar has room to fall and argues that there are structural issues with the economy overall that really won't allow Canada to grow at a rapid pace. Welcome to In This Economy. My name is Mike Eppel. Joining me on the line is David Rosenberg, the president and founder of Rosenberg Research. Hello there, David. Thanks for joining me.
Thanks very much, Mike. It's great to be on. And after your introduction, I feel I just met somebody who's at least as bearish as I am.
I'm not trying to be pessimistic, but when you look at the data, and it was interesting, David, the response to the GDP numbers that we got for November, yeah, the headline was flat, whatever. But underneath the surface, I didn't see anything particularly positive. You have an op-ed in the Globe and Mail this week about your thesis on what you're seeing in the economy right now. You're no longer bullish on the Canadian dollar, and you were kind of raising the risk assessment of a recession, which we haven't seen yet. But I mean, look at 2025. 2 of the 4 quarters. I mean, if the December numbers track the way we think they're going to, 2 of the 4 quarters were actually negative, and that wasn't a recession, but boy, oh boy, it wasn't exactly consistent, other than its inconsistencies for a lot of last year.
I still believe it's the C.D. Howe Institute that ultimately is the arbiter of whether the economy is in an official recession or not. And they actually have different grades of severity. But the way I look at the situation is this. When you look through the quarterly and monthly wiggles in the data, the year-over-year growth rate in real GDP is the grand total of plus 0.6%. So, of course, people will say, well, thank God there's still a plus sign in front of it. But it's pretty close to zero. So if you don't want to call it recession, it certainly is stagnation. But then when you count on the fact that even with the immigration curbs in place, the population is still rising, call it 1.2, 1.3% at an annual rate. So when you look at real per capita GDP, which is really the benchmark for how successful your economy is doing, that metric is still in decline. That is the one thing that hasn't changed from the Justin Trudeau era, is the secular contraction in real economic activity per person.
Yeah.
That is yet to be arrested. So that's the first thing that I would take note of. And the other one is look at when the Bank of Canada started cutting interest rates in the spring of 2024. The Canadian economy over that year and a half plus interval has expanded at the grand total of a 1% annual rate. That is extremely weak. Like you would have thought after a 275 basis point cumulative cut in rates that you would have started to see already a lift in economic activity.
Yeah.
But it's basically call it 1% over that time period, to which I say, is that all you get for your money?
Well, look at what the biggest sectors of the economy did. I mean, if you look at, auto trade down, manufacturing overall down, steel, aluminum, tariffs, lumber, all of them. I mean, these are the job creators. So, you can have retail and consumer spending kind of propping it up, but when you've got that component of the economy showing as much weakness as it was, eventually that's going to filter through to consumer sentiment. I think it already is it not?
Well, I'm not going to downplay all the Trump and tariff-related uncertainty. However, when you take a look at most of the net effective tariff rates that were slapped on globally, and you consider that the vast majority of what Canada ships to the United States is covered under the USMCA, we got off pretty light. The net effective tariff rate in Canada is still amongst the lowest in the world and went up by less than most other countries. So I understand that that's a cloud of uncertainty, but I don't really think that you can just pinpoint Trump and trade on the fact, as you said, that manufacturing activity in Canada is down 5% year over year. That's a big number. And exports are also down year over year. And you'd be thinking that, well, there should be some offset from the firmness we're seeing in the resource markets. But exports are down year over year. In fact, the level of exports in Canada is lower today than it was in the spring of 2022. So I think it's easy to point fingers, and we should point fingers at these U.S. trade actions. But it's hard to believe that's the only part of the story. The other part of the story has been a secular or structural story in Canada, which is our chronic lack of competitiveness. That nobody talks about. So in some sense, these trade issues have acted a little bit, or maybe more than a little bit, as camouflage over a decade of lost productivity. And that's not what's been changing. So, I would say, look, I was very charitable when the Liberal budget came out. I think I gave it a grade of B-, which I'll tell you the truth. I don't even think I've given a score that high to any federal budget since the Harper years. But what is being done? I mean, tangibly, not just talk about fast-tracking natural resource products and reducing interprovincial trade barriers, which I've only heard about year in, year out since I started in the business in the mid-1980s. Instead of embarking on measures to stimulate internal domestic demand by a broadly based tax cut for individuals, for businesses, for capital gains, and maybe even in this Liberal government, cutting corporate taxes or capital gains taxes, that's just like off the table. But you see, that is what ultimately creates risk-taking and investment and then growth in the productive capital stock. And of course, you talk about all these things to non-economists, their eyes just glaze over. But there's more fundamental problems here, okay? Like you can't point to these numbers. You can't point to the fact that we've had almost no impulse on the economy for the Bank Canada's done. And that's not all about trade frictions. That's about all the other factors that have undermined Canadian economic activity for the past decade. So, I find it very interesting, that what happened was that the Canadian dollar was roughly 70 cents in November. It spiked up to 75 cents recently. It's pulled back from there. And it had everybody thinking, look at the Canadian dollar, look at the ground is gaining. And everybody started thinking, boy, something right must be happening in this country. But it was a false signal because the US dollar was going down against everybody because of this widening US dollar debasement trade and a rising lack of confidence over US economic policy in general that has nothing to do with what's happening in Canada. If you want to get a gauge as to what's happening in Canada, don't compare the Canadian dollar to the US dollar. The structures of both economies are completely different. Compare Canada to Australia. Compare Canada to New Zealand. All these countries are resource-based economies. And the Canadian dollar in the past 2 months is down over 4% against the Aussie and against the Kiwi. So that's telling you something. I mean, the question becomes, outside of little interim tax gimmicks, what is being done in Canada to produce an environment of permanent reductions in top marginal tax rates? And I'll tell you, the biggest cardinal sin happened when the government in Ottawa allowed the U.S. top marginal corporate tax rate to come significantly below where it is here. There was a time period where we had a slight advantage. Now we have a huge, call it 7 percentage point disadvantage on the top marginal corporate tax rate. So if you're going to decide where to set up business in North America, you're going to get more of a tax advantage in the U.S. than you are in Canada. We never addressed that. We never responded, never mind to the big, beautiful bill. We never responded to the initial shock from Trump and Congress taking that top marginal rate down from wherever it was, 35% down to 21% back in 2018. We never responded to that. Why? And I don't even understand why there's not more of an uproar, because that's just not a Bay Street issue. That's also a Main Street issue, because 2/3 of the jobs in Canada are created by the business sector.
Well, when you talk tax cuts, David, that budget that you gave a B grade to already had a $78 billion deficit. Is it cut taxes and hope for to offset it with better revenue coming in?
Yeah, well, you offset it through spending restraint, which I got to tip my hat that there is, on the operational side, there is actually a significant slowing in the growth of program spending. But, there's the old refrain, in the land of the blind, the one-eyed man is king. And actually, in terms of debt and deficit ratios at the government level, at the federal government level, Canada is as strong a financial position as Germany is. We are not a fiscal. We are never mind an emerging market country. Actually, most of those emerging markets now are looking pretty good from their fiscal situation. We're not Italy, and we're not the UK, and we're not France. Our fiscal position relative to the United States is so much better. Now, you could argue that being the reserve currency of the world, the U.S., of course, has much more expansive borrowing capacity. But point number one, we've run up fiscal deficits as a share of GDP much harder than they are right now. I'm not advocating that we basically ignore the fiscal side. But relative to most other parts of the world, our fiscal position is actually pretty strong. And in some sense, and I guess that we then would have a debate over the Laffer curve, but there will be, theoretically anyways, a productivity and economic activity payback from lower tax rates that you'll get back on the other side. Mm-hmm. The one thing we cannot deny is that I think we're 11 years in a row now of net direct capital inflows leaving the country. Like Canada has seen net foreign direct investment outflows 11 years in a row. Now, again, this is an economist talking, and I imagine most of your listeners are not economists. So, it's like basically I got to go to a chalkboard like an economics 101 professor. But nobody ever brings up the fact, and maybe during the election campaign, Pierre Poilievre thought this might be just too technical for everybody. But when you're losing money, when the money is being drained, and we're not talking about paper money, this is real physical plant and equipment leaving Canada on net every year for 11 years. Think of the jobs that costs. Think of the government revenues that are foregone because of that outflow of economic activity. And yet nobody talks about it.
Mm.
And so, yeah, Donald Trump comes along. I get it. We have this global tariff war. Like I said, but most Canadians don't know is we got off lightly compared to a lot of other countries in the world. All that said, that's camouflage for a lot of the structural issues that have undermined the economy here for ages that have yet to be redressed. And a big part of it is that next to the giant south of the border, the United States, we have allowed ourselves, for whatever reason, to become more tax uncompetitive. And especially at the corporate level. Now, maybe that just doesn't play in the Canadian electorate. But you see, we're also uncompetitive on top marginal tax rates on the personal sector. It's not so easy, though, for people just to pick up and move to the States, especially now. But capital has no barrier. Capital has no border. And we've been suffering capital flight for 11 straight years, and it's not over and it's not been redressed. The way you redress that, and I wrote a report on this before the budget, I guess nobody will listen to it, was what's the solution in Canada? Of course, we're going to do trade deals with other countries. It's going to take years to really diversify our way out of the United States. And that's not even realistic that that's ever going to happen to any meaningful degree just because of the proximity and the border. And in my report, I said, why doesn't the federal government turn Canada into Ireland, make Canada into a global tax haven and attract physical capital into the country? And you know what that'll do? It'll create jobs. We will not be sitting here right now with an unemployment rate flirting with 7%.
Have we been basically just resting on the fact that the dollar is, 70 cents or just above 70 cents as the offset to the higher taxation rate? Because if the dollar were to go up, then you'd have, American companies specifically. I know Trump wants to get them all back into the States, but when you lose that dollar differential, then that would be almost catastrophic.
I agree with you, but when you think about it, think about how pathetic it is that the competitive crutch for Canadian industry has to be a 70-cent Canadian dollar.
Which, of course, also makes it more expensive for us to import goods and raises our...
Exactly. We have to cheapen our currency to buy our share of global exports. And when I say pathetic, it's with a capital P. And you're right, it actually reduces our global purchasing power. It reduces our relative real incomes compared to the rest of the world when you cheapen the currency, because your tax system is so uncompetitive. You rely on the crutch of a weak currency, which, of course, is just ipso facto a reduction in the standard of living. I talked before about what Canadian real GDP per capita has been doing in Canadian dollar terms. Can you imagine what that looks like in US dollar terms or even in euro terms? Mm-hmm. Or most other currency terms? And I still think that we're just, nibbling around the edges. I said before, look at what the Canadian dollars were doing lately against the Aussie and the Kiwi. Of course, they're fortunate to be more hitched up with Asia, which has really been the engine of economic growth globally for some time and still is today.
Yeah,
But when companies come and make a decision on North America, they're deciding Canada or the United States. And what's not been redressed, of course, we can point fingers. It's easy, and that's why I said it was camouflage to a large extent. We don't look in our own backyard. And the one thing that I would do immediately, but maybe it doesn't buy votes, so I guess it's not going to be done. We still, to this day, what is it, like 8 years later, responded to what really was a negative shock for Canada, which was the U.S. taking their top marginal business income tax rate so far below Canada. To this day, we've never responded. And nobody ever asked the question, So why should the government ever have to give an answer?
I want to switch to what you think the Bank of Canada is going to do, because they held steady on policy in January and cut rates a whole bunch in 2025, 275 basis points, I guess it was. But I don't remember hearing Tiff Macklem being as hesitant and or guarded about what he thinks about what's going on in the United States and what he, what may or may not transpire this year on trade. He kept saying it's uncertain. We don't know. It'll depend if we get a trade deal with the States or not. And the fact that there had been talk some have been said, well, by the end of the year we might be raising interest rates, and I'm saying to myself, what? How does that make any sense? If there is no trade deal, forget raising interest rates. They got a cut, and then we got as well, David. I don't know if you saw the Toronto real estate numbers for January and this morning. They were abysmal. 19% drop in sales, prices down something like 6%. I know January was an absolute dog's breakfast for weather, and nobody's probably buying houses or doing open houses or any of that nature. But nevertheless, housing has become intrinsic to, personal wealth. And if you see that dropping, then you're not going to spend, and it just cascades upon itself. I would argue, and maybe you would too, that they got to cut rates.
I don't see them raising rates. I know there's some of my competitors on Bay Street that think that's going to happen. But then they have probably a different set of economic forecasts and assumptions than I do. But you're quite right. Look, the proof of the pudding is in the eating. The bank started cutting rates in the spring of 2024. We're already in the second month of 2026. Cumulative rate cuts, as you said, 275 basis points. The lags cannot possibly be that long. We should have seen a thrust already. And so when you dig through the data, because we talked about GDP, but we talked about exports and manufacturing, that probably tells you the Canadian dollar isn't weak enough. But it's really quite stunning that you would have home prices nationwide down 2% year over year. You talked about the existing home sales for January. Well, we got not too long ago the new home sales for Toronto, for the GTA in December, all-time low, going back 45 years. And when you look at the national numbers, out of those GDP statistics, residential construction is as flat as a beaver tail. The retail sector, by the way, looking at it, looks like we're going to have back-to-back quarters of sequential negative growth in real retail sales. So the retail sector is actually in a technical recession on its own. The retail sector, construction, housing, sales, prices, these are all things that are very closely linked to the direction of interest rates. They haven't responded. The Bank of Canada, they seem to think, well, we've gone 275 basis points. That's got to be enough. But if it was enough, you'd be seeing the credit-sensitive sectors of the economy responding, and they're not. So maybe the lag's just longer this time, or Tiff Macklem and his group throw up their hands and they like to say, well, there's structural issues and impediments that transcend monetary policy. And then they're thinking, well, does that mean you still shouldn't be cutting interest rates? I mean, the bottom line is that when you look through the Bank of Canada's own forecast against actual growth that they expect and potential non-inflationary growth that they have as their estimates, this disinflationary output gap in Canada that's causing the unemployment rate to be on an upward trajectory and has caused underlying inflation to really fall within the Bank of Canada's comfort range, no matter which metric you look at. That just acknowledging that the output gap is not going to close anytime between now and into 2027, and that somehow we're not going to respond to that. I just sort of, raise my eyebrows. I do think that they'll be cutting. I think they're being deliberately patient. I think they're just waiting to see if the lags are longer right now. And they might think that we've done a whole lot already.
Listen, I don't want to leave this just talking about all the things that are kind of going wrong or sideways right now. What do you see as positive in the economy? I mean, look at what's going on with the metal prices. Last time I checked, we produce a lot of metals in this country, gold, silver, copper, whatever. We've got the ring of fire that still has to be developed that, certainly could be a big economic generator. And I don't want to say we're a forest and rocks kind of economy, but at the same time, at the end of the day, and oil too. We've got a lot of things that the world wants, despite what Trump may claim. So maybe that's something we got to build upon again. I think gold, for example. I think I saw you wrote here that you think gold's got a lot more room to run. For example, despite it being over $5,000.
Yeah, well, look, we got to separate two things. Like, I'm not going to go in front of an audience and say I'm bullish on gold, therefore the Canadian economy is going to embark on some sort of boom. I will say that the gold mining shares have like a 13% representation in the TSX, and that the gold mining shares at the TSX have provided 10 percentage points of alpha over the course of the past 12 months. So I would say, yes, you can be bullish on the stock market. The TSX is not GDP.
Right.
Yeah. The bottom line is that if GDP was a ticker on the TSX, I might want to short it. But a lot of the TSX, as you said, there's the banks, but the banks are big multinational corporations. They have businesses, branches everywhere, not just Canada. But the resource prices that you mentioned, is it Canada that produced the higher gold price, or is it the global central bank? This is the irony that you mentioned the gold price, and all these global central banks are adding to their reserves. That's really the principal story for gold. Not the only story, but the big principal driver of demand for years now has been global central banks reallocating their foreign exchange reserves out of paper and into bullion. Guess the only central bank that hasn't done that is the Bank of Canada. We're the fourth largest gold producer in the world, and there's no bullion in the vaults at the central bank. In fact, the Bank of Canada was the first central bank to start selling gold in 1980, and they were still selling when they got to zero, believe it or not, in 2016. So, look, I take what you're saying. Yes, there is a positive story for Canada from commodity prices. Commodity prices are not set in Canada. That's not like you can't point to the Canadian economy and something miraculous in Canada causing commodity prices to go up. That's being determined by what's happening globally. So we benefited from that. You can argue that that's been, an antidote to all of the other things. But I mean, we can actually, through policy, influence productivity growth, which is, to me, the mother's milk for prosperity. To tell me, well, gold's doing this, sure, we've lucked into that. That's not a made in Canada event. Besides the fact that because there are still bottlenecks, I mean, it's nice to talk about fast tracking natural resource projects. You got to ship this stuff out. That you would think that the one part of the Canadian economy that you'd be thinking is, it's one of the reasons why I gave the federal budget a B- was I thought it was going to be a supply side budget. But talk is cheap. And the reality is that when you look at the same GDP numbers that you and I are looking at, and you dig beneath the surface, do you know that the resource sector in Canada has not expanded one penny since the turn of last year? So in real physical terms, in terms of actual economic activity, not the price, but the physical economic activity, that's about jobs and about production, that hasn't moved in almost a year. So, no, I'm not even willing to give a pass on that. And, in the name of trying to find, look, I know that my reputation is Rosenberg, the perma bear. He can't find the silver lining, and can't find the needle in the haystack. Like, I've heard it all, but I tried. Like, I gave the federal budget a B-. I did actually turn positive on the Canadian dollar last fall. I wrote a whole report showing that I'm hoping things are starting to turn. I was like, Al Pacino in Godfather 3, and then I got, then they pulled me back, so it's one of those moments where, I'll tell you the truth, I have a little sense of buyer's remorse of having turned positive. I did my best. But the numbers are just not playing out like they should. And we have to, and it doesn't help anybody to sugarcoat it. And we have to stop blaming Trump. I'm not a Trumpy. I'm not pro-Trump, but we got to stop the blame game and start thinking about how will we drive internal dynamics to stimulate domestic demand through homegrown policy. To think that interprovincial trade barriers, like I said, we're always talking about that. And all these moves for trade deals with other countries, it's going to take decades before that bears fruit.
I was just going to ask you about that. Is the issue with that because it takes so many months or years to actually show an economic effect? I mean, well, look, if we start shipping canola to China, that at least has got to be a positive for something, right?
Well, I mean, you know what? Yeah, okay, that's going to be great for Saskatchewan. What share of that is the Canadian economy? I mean, canola. I mean, Mike, you're sounding like Donald Trump talking about selling soybeans to the Chinese. That's basically a fraction of a fraction of a fraction of a percent. Let's talk about meat and potatoes.
Yeah.
Let's talk about. I mean, okay, great. Canola, wheat, great. But it doesn't really spin the dial. It'll spin the dial out west, okay? However, we're a national economy. We got to sit and think about what's going wrong and what's gone wrong, not just this past year, but for many years.
David, listen, I feel like I've kept you much longer than I had promised originally, and we are out of time, but I really appreciate you doing this chat with me today.
Mike, it was a pleasure being on with you, and I'm going to make a recommendation that we take this show on the road together.
Mike and David's excellent adventures on the economy. Thanks, David. It was great talking to you. And that was David Rosenberg, the president and founder of Rosenberg Research. Say, listen, if you like this episode or anything else you've heard on the Frequency Podcast Network, or have any ideas or critiques, comments, criticisms, what have you, you can email me directly at mike.eppel@rci.rogers.com. And on social, I go by @Eppman, EPPMAN. You've been listening to In This Economy, and thanks for listening. We'll talk soon.